Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. In the first few months of the pandemic, almost every single forecaster was predicting a dire outcome for the property market, including declines in house prices of up to 20%. I don't think anybody expected them to go the other way, and definitely not by as much as they have. Property prices across the country have now surged more than 16% over the past 12 months, the fastest annual growth in 17 years. The market has even defied recent lockdowns, with valuations slowing but still increasing across all capital cities in the past month. I'm quoting the CoreLogic data as well. It's the best in the market. And as we often do here at Fear and Greed, I thought we'd go straight to the source. Tim Lawless is Head of Research at CoreLogic Asia Pacific and my guest this morning. Tim, welcome back.
Hi, Sean. Thanks for inviting me on your show.
How long have you been looking at property prices, Tim?
It makes me a little bit anxious to say, to be honest. It's about 20 years now, I think, but I've been at CoreLogic since 2007. Prior to that, I was at Collier's and PRD. And funnily enough, before that, I was actually at RP Data, which eventually evolved into CoreLogic.
Yeah. So in that 20 years, have you ever seen as big a surprise or turnaround in house prices as the last 12 or 18 months?
Nah, I think this really tops it. You know, there's been some spectacular growth cycles across Australia, say back in 2001 through to 2004. We saw the GFC where values fell pretty quickly. We saw all the macro-prudential and the credit restraints through 2017 to 2019 where the market was going down. But yeah, I think the most recent 18 months or so has been the most uncertain and most surprising by some margin.
Why do you think everyone was so pessimistic to begin with and then got it so wrong?
Yeah, I think we have to look back at the mindset of everybody back in, say, March and April of 2020. Back then, this was, COVID was something very new. It was something that was very scary, and nobody really knew how Australia was going to fare during this global pandemic. And I think everybody assumed the worst. But quite quickly, it became apparent that we were keeping a lid on the virus pretty well, at least compared to other countries. Probably also no one really, thought through the amount of fiscal support that was going to be coming through the system that actually supported the economy and really got us out of the doldrums quite quickly. And of course, it's really that boost economically that got sentiment quite high and got the housing market back into a very strong growth trajectory.
Okay, so what are the key factors? Sentiment, but what was driving that?
Yeah, well, obviously interest rates were a really big part of this. So monetary policy is probably at the basis or the foundations of this really strong rebound. And we know from very low interest rates that really spurred demand. So anytime we're looking at housing markets, we always look at the supply and the demand side factors. So from a demand side, very much about very low interest rates and then improving confidence as the economy improved. On any of the sentiment readings, we saw consumer sentiment get back above average levels by late last year and track to well above pre-COVID levels through earlier this year. Sentiment's come back down a little bit since then because of all these spot lockdowns. But that surge in confidence was a big part of bringing demand back into the marketplace as well. And then on the supply side, while we've had this huge surge in demand, we've had an absolute lack of supply. There hasn't been a lot of vendor activity, or at least vendor activity has been about normal, put it that way. So we're seeing about a normal amount of new stock coming on the market at a time when buyer activity is about 40% above average. So it's really that mismatch between how much available supply was in the market and how much demand had been boosted. And that created a lot of urgency amongst buyers. We hear that term FOMO all the time, the fear of missing out, which was really quite, I think, palpable, particularly at the height of the market back in March earlier this year. And that sense of urgency was another factor really pushing up prices as quickly as what we've seen over the past 12 months. As you say, up a little bit more than 16% over the past year.
Now, valuations have increased across the country. If we take the capital cities, though, it's the East Coast has done a lot better than the West Coast.
Yeah, absolutely. And even outside of the East Coast, we've seen some of the smaller capital cities outperforming the larger ones as well. So at one end of the spectrum, we've seen markets like Darwin. Surprisingly enough, Darwin is the best performing capital city over the past 12 months, and housing values there are up 23.4% over the 12 months to July. And of course, that comes after a really long sustained downturn in Darwin and Perth between the middle of 2014 and the middle of 2019. Then you've got Canberra, housing values in Canberra up about 21%, in Hobart up about 22% as well. So the smaller cities have done very well. They've probably done a pretty good job at keeping a lid on the virus. But across the majors, absolutely, this is the story about Sydney again. Sydney housing values are up 18% over the year compared to Melbourne, which is only up 10%. So the reason we're seeing such a big difference between Sydney and Melbourne probably comes back to, well, a couple of things. I think Melbourne's obviously had a tougher run through COVID with more lockdowns and disruption. But Melbourne's also got a much weaker apartment market, which is really dragging on the overall annual figures. Apartment values in Melbourne are up a little bit less than 6%, whereas in Sydney, they're up nearly 8% in Sydney. So not as much of a drag on the headline growth rates. In Brisbane, we've also seen a very strong performance. Values there up about 16% over the past 12 months. And Brisbane seems to be holding its growth rate much more firmly than, say, Sydney or Melbourne, where we have seen the market losing a little bit of steam since the end of March.
And then Perth hasn't done so well either?
No, Perth's a bit surprising. And we've seen housing values in Perth rise by nearly 11% over the past 12 months. So I think in the context of things, that's still an extremely strong result. We've seen housing values rise by nearly 11% back into double digits, which is remarkable for Perth, considering a couple of years ago it was still in the midst of a long-running downturn. But it does look like the Perth marketplace is underperforming for whatever reasons. Maybe its vendors are a little bit more eager to offload their stock there. Mm-hmm. Listing numbers have been a little bit higher. They're probably a little bit more sensitive to some of the fragility of the economy and the lockdowns as well, it seems, after going through such an extended downturn in the housing market. Yeah. Still, 11% in a year, I think, is quite a strong result for property owners over there.
Well, I mean, I suppose talking about apartments in Melbourne and Sydney, 6 to 8%. In any normal year, you'd be quite happy with 6 to 8% appreciation.
Yeah, absolutely.
Yeah, it's your fear of missing out. It's the fact that everything else is going up so much, you feel you're underperforming.
Yeah, that's a really good point, Sean. And if you look at around Melbourne's apartment market, there's some real extremes. At one end, you've got the inner city high-rise precinct where there's some evidence that values are falling in those markets like the CBD of Melbourne itself, Docklands, Southbank. So your high-profile, high-density markets. The reason for that is vacancy rates in those areas are quite high. There's been this absence of foreign students, which means that the areas aren't very attractive to investors anymore. Our rents have come down in some of those precincts by about 30%, which makes them less attractive for a yield. And then in Sydney, you can see that the apartment market's actually quite a bit more resilient. And I think that probably is reflective of a much more mature apartment market in Sydney, much worse affordability constraints as well, that seems to deflect more demand back into the apartment sector relative to Melbourne at least.
Stay with me, Tim. We'll be back in a minute. My guest this morning is Tim Lawless, Head of Research at CoreLogic Asia Pacific. What about regional Australia? I mean, my hometown in central New South Wales, Orange, some of the house prices there are going through the roof. Regional Australia's done really well.
Yeah, regional Australia's really had its heyday, although the gap between the capital cities and the regional performances is now starting to narrow. Through the second half of last year, absolutely it was a story of the regional markets outperforming the capital cities. But over the first 7 months of this year, we've seen regional Australia increase in value by about 14.5%. Capital cities are up about 14%. So not much difference at all. But again, there are some pretty extreme examples around regional Australia. You've got markets like Byron Bay and Noosa, the Central Coast in New South Wales, the Gold Coast. All those markets have seen values rise by around 22 to 25% over the past 12 months. So it does seem to be this underlying more of a lifestyle trend that's driving a lot of these areas, not necessarily just coastal markets, but also areas like the Southern Highlands, just outside of Sydney, and some of the agricultural markets as well. You mentioned Orange, or there's also Dubbo, Wagga, Albury. All these markets have seen a break in the drought. They've seen agricultural yields improve, which is also helping to support a rebound in those more rural markets.
Okay, so that's where we are today, Tim, but what we all want to know is where will we be tomorrow, or at least in 5 years' time?
That's a much harder question to answer, isn't it, Sean? There is a lot of uncertainty at the moment, of course, because of the lockdowns and because of COVID, and we don't know how long these current restrictions are going to be extending for, particularly in Sydney, which the case numbers at the moment just seem to be quite high.
Yeah.
So where to from here? I think the short-term answer for that is we are expecting there to be ongoing upwards pressure on housing prices. We do expect values will continue to rise through the rest of 2021, but probably not at the same pace as what we've seen through the first half of the year, simply because of affordability constraints becoming much more challenging. I think that's probably why we've already started to see the rate of growth slowing down, is that first home buyers have become much less active and fewer people can actually afford to raise a deposit to get into the market. But longer term, maybe some of the more significant headwinds outside of affordability could be things like tighter credit conditions. If we see another round of macroprudential policies rolled through, we know that would have a fairly immediate dampening effect on credit availability, which then flows through to housing activity. And then further down the track, there is some speculation we could see interest rates rising a bit earlier than, say, the forecast of the RBA, which is still 2024 the earliest. I think there's a growing level of expectation that rates could lift earlier than that, although I think the fact that we'll probably see a negative GDP result in September could push that out a bit further. They're probably the two more significant headwinds, but in the meantime, you've got this uncertainty around COVID. Hopefully that starts to dissipate as we get the vaccine rollout a little bit more effective. And on top of that, then you've also got gradual worsening from affordability as well.
Okay, so what happens when, we will get through this COVID period? What happens when the students start coming back, when migration increases? Will that put more pressure, particularly on apartment prices?
Well, you'd have to think that open borders would be a net positive for the housing markets. But generally what we've seen from overseas migration is a much more immediate impact on rental markets rather than home purchasing and housing values. We can see that really clearly in the markets that are most exposed to overseas migration, which is Melbourne and Sydney, in that order, particularly the inner city precincts where foreign students, for example, tend to be a very large component of tenancies in the apartment sector. So I think if we did start to get foreign students back, for example, that should help to shore up some of those inner city precincts. But still, there's no guarantees that foreign students will come back in the same numbers. We know there's a lot of tension with China, for example. A fairly large component of those foreign students were coming from China. And then on top of that, I think there will be a lot of debate around what does our migration policy as a country look like. It mightn't be the same as what it was pre-COVID, as we see governments and policymakers just keeping migration relatively low in order to keep labour markets tighten more quickly, which will help, of course, the RBA to achieve their inflation target.
Tim, thank you for talking to Fear and Greed.
Always a pleasure. Thanks, Sean.
That was Tim Lawless, Head of Research at CoreLogic Asia Pacific. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.